I need you to watch this video to the end because I'm about to show you some things that you've never seen before and give you context for what we got going on over here at the Multifamily School Mentorship. You're here because you're someone who isn't fully satisfied with what you are currently doing. You want more. You want to build generational wealth for you and your family. You know that rental property is one of the best ways to have money working for you while you sleep at night. You want to spend maybe more time with your family, less time slaving at a job that you currently have. Maybe you want to give more back to your community, build up for retirement, be able to travel when you want without the worry of the money. Whatever your reason, investing in apartments is a vehicle to get you to where you want to go. So let me give you some background so you know why you should even be listening to me, and more importantly, the bigger picture for why I'm even mentoring and coaching students like yourself. I currently run an investment company with offices in both San Diego and Austin, Texas. We hold about 500 plus units, approximately $110 million in assets. These assets include deals like this. This is a 31 unit deal we did in Kansas City. We bought it for $1,550,000. Now it's worth over $3.6 million. It produces nearly $6,000 a month in free cash flow. Or look, this other deal, 121 unit deal in Texas. We bought for over $12 million. We'll sell it for over $20 million and it pumps out nearly $30,000 a month in free cash flow. We recently completed another deal in Las Vegas, Nevada, 160 units worth over $74 million. That's going to be over a $20 million profit. I am a multimillionaire because of real estate. It's generating over 5 figures each month from our deals. We're on our way towards 10,000 units and $4 billion in assets. Now look, I don't say this to flex. I say it because it's important to get mentored by someone who's active in the market, not some random hired coach who isn't really executing. As you know, there are a lot of gurus out there blowing smoke up people's you know what. You want someone who's currently doing it, has been there, has done that, can walk the walk, can show you the nuance to make this happen for you. So the greatest thing about this, you're getting me, not some random hired coach. But it was not always like this. In 2008, my family lost it all in the financial crisis. It was actually April 8th, 2008, 8:35 in the morning. I was working in my dad's company. My dad walks into my office, closes the door, sits down. And he told me, look, Justin, the banks are shutting everything down. Now, my dad, who's a pretty direct person, told him, look, you guys can't do that. The banks replied to him, sue us. They knew everyone was about to go under. Now, I tried to remain calm, but I knew that at least the path in my mind that I had created was all about to change. Have you ever heard the saying, in moments of suffering, greatness is born? That was a moment. I watched everything that my dad had built over 40 years completely collapse. My dad always says, look, Justin, there are doers and there are dreamers in this world. Doers take their dreams and they make them a reality, while dreamers, they keep on dreaming, right? They talk, dream, 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 but they never take action. One of the hardest things to watch is seeing someone that you love lose everything that they had built. It was devastating. But remember, in moments of suffering, greatness is born. I struggled for a few years until I got mentored and partnered with a buddy of mine to buy our first condo in 2010 for $100,000. We put $25,000 down, $75,000 loan. Then look, we bought a triplex, a fourplex. Then we got into a little bit bigger ones, 5 to 10 unit deals, and then 20 to 50 unit deals. And now we're doing 100 plus unit deals around the country. And when I reached where I am today, I did not intend to coach. I wanted just to keep growing and doing what we're doing. However, what I've learned in my life is that by giving, helping others, you expedite and create abundance, and you create abundance for all. It's the law of reciprocity. So by creating a vibrant, active investor community, teaching you and others the proper way to buy and invest in apartment buildings, we all win. This is why Multifamily School Mentorship was created. This is also why I launched the podcast, Abundance to Give. So now it's time to show you some of the goods, give you some training and illustrate why apartments, why now, why you need to get in on this, like yesterday, not tomorrow, not weeks from now. If you knew what I knew about the opportunities coming our way, your way, then you'd be on this like white on rice. Just think, what if you were better prepared prior to 2008 and knew about the rising storm and could get in on it? Okay, let me get into the studio. Let's show you some numbers. Let's go. Okay, here we are inside the studio. So what I'm going to be going through a few things here is to really show you the main benefits of apartments. You may have read about this online, see some videos and so forth, but I'm going to walk through a few of them so you can best understand it, kind of give you a head start so that way once you get on the calls and do these things, you'll have a better understanding of how the multifamily works, how you would do simple underwriting of a deal, how you would find deals, how you would raise the money, how you would manage the deals, how you would close on them, stuff like that, okay? So let's get started with the main categories for why you buy real estate, but why you buy apartments. Remember, people need 3 things. They need food, water, and what? Shelter. And more people are renting than owning these days. With the cost of housing, inflation, everything going on, we're moving into a renter nation. We're moving away from the traditional, everybody go buy a house and that traditional model that you would see, and more into the European model where you see a lot more people renting. So this multifamily housing, the apartment buildings and stuff like this, right? Higher density, especially in the urban zones, are critically important to be able to supply the housing that's needed in the United States. So it's critically important that you get in on this and you buy the small apartment buildings or even the large ones. So let's get into the main categories for why apartments, okay? Number one is we all hear and talk about the cash flow. Number two are the profits, right, that come from appreciation, selling a building, flipping a building. It's like you flip a house, you can flip apartment buildings. Okay, you can also hold on to them for 3, 5, 10 years, or you can move in and out of them in, say, 24 months. It's really up to you. There's different models. The biggest one that people don't really understand and calculate is the tax shelter. And then lastly, the inflation hedge. Just to give you an idea what's happening right now is as you're seeing, prices go up, things go up, costs go up, so too is housing. You're watching it. Rental prices, everything else, everything's going up. It's a great inflation hedge, especially if you have fixed rate debt, right? Say 3, 4, 5%, maybe 6% mortgage on the property. And you have inflation that's north of that, right, where you're doubling the rate of inflation, or even if you have inflation lower and you're earning returns greater than that, because if you're locked in at a fixed rate debt of 3 to 5%, maybe 6%, but yet that property is appreciating at 8, 10, 15%, right, with rent growth, appreciation, all that stuff going on, that's where you win, because you're appreciating faster than the rate of inflation, so you're better off, okay, and you have fixed rate debt against the property. So these are the 4 main categories for why apartments, okay? Cash flow, we all know that. Mailbox money, profits from a sale or a disposition, a refinance, cash in, cash out. We go into all this stuff in the mentorship, okay? Tax shelter and inflation hedge, the main reasons. Now to summarize, I get a lot of people asking me, hey, how do I start? Where do I start? How do I buy apartments? What do I do? I've tried to simplify this as easy as we can, and obviously there's a lot of detail in the mentorship. That's the whole point of it. But if you're going to be buying an apartment building, these are the 5 steps and processes you're going to be going through. You got to find the deals. How do you find them? You have to be able to analyze them. How do I tell if it's a good deal or not? And do it pretty quickly. How do I raise capital? Raise the money for it. If I don't have all the money, how do I go raise that money? To whom and how? How does that get structured, both legally, financially, all that? Show you all that. How do I close escrow on a deal? How do I do proper due diligence to make sure that I'm inspecting the property physically, I'm inspecting the property financially to make sure that all the numbers are right, and make sure I'm not getting into a money pit that I'm gonna have to put a bunch of capital improvements into it, to deferred maintenance fixes, all of that. How do I make sure of that stuff? We go through that in the closing process. And then once you own the building, how do you manage it correctly? What is the proper way to property manage and or asset manage a deal? We go through that step by step, but this is the process for buying an apartment building. And I don't care if you're buying a 2-unit or you're buying a 100-unit. It's irrelevant. Same process. It's just going to have more zeros. You're going to have more zeros. You do a 100-unit deal, you're talking 20, 30, million plus. 2-unit deal, maybe 500 grand, $1 million, depending on where you're at in the country. Okay. Same process though. Okay. Very, very, very important. You have this thing called on and you have this thing called off. You're like, what? On and off market. Now, only about 40% of all the commercial real estate sold in the United States of America is sold on market. You can go to LoopNet, you can go to Crexy.com, you can go to any of those portals. You're only going to get to see about 40% of the actual inventory that's being sold. Because unlike residential, commercial real estate's all held close to the vest. A lot of brokers keep things close. It's either direct to seller, broker, buyer to broker. So that good old boys, good old girls club is extremely important, right? Now I'm going to show, and we show our students and mentees, how you use the on-market deals to get to the off-market opportunities. Because 60% or maybe even more are done right here, are done right there, and you know it. So the question is, how do we get those? Well, you're not going to get these if you don't understand these. If you're a novice and you're new, there's no way on planet Earth a broker is going to give you an off-market opportunity. So this is why you may feel frustrated, like that's where all the deals are at. I know that's where all the deals are at, but you need to, walk before you run. You got to play in the on-market space. Our first 2 deals were in Kansas City, Missouri, 27 and a 31-unit deal. That were larger ones, And those were both on-market deals. And we used those 2 deals as our springboard to start getting access to all the off-market. And both those deals were fair deals. We got them at decent prices. We've done extremely well on them. So it's not that they're not good opportunities. You just need to buy them right. But you're going to start with the on-market stuff to get to the off-market stuff, because by doing that, you're going to build trust in the marketplace with the brokers, with the sellers, with the players. And it's just, you got to pay to play. And you got to go to the on to the off. So that's how you're going to find the deals. How are you going to analyze them? We give you Excel templates. We have 2 of them. We have a basic one that we go through, and then we have a more extensive one for bigger, more elaborate deals. We give these to you, thousands of dollars worth of stuff in the mentorship, and we walk you through them all the way. We have videos on everything. You see me underwriting deals live in real time. All of that stuff gets done, and we break it down for you. How do you raise the capital? We walk through that. You're going to be dealing with 4 different people when you're raising money, right? Friends, high net worth individuals, private equity. Okay, private equity, and then you're going to do, let's call it institutional or family office. You may be saying, what in the world is family office? Don't worry about that. You won't be dealing with any of that, and you won't be dealing with any of that at this point in time. Pretty much every one of you will be dealing in this area. Friends and high net worth individuals. Friends and high net worth individuals. And this is how you raise capital. And we show you exactly how to do it. We give you all the tools to do it, and you just need to, copy, paste, repeat. And that's why you have the mentorship, is to help you go that 0 to hero and hold your hand step by step as you're going through it. Very, very, very important. Another thing you're going to get with us, obviously this is important, is like the investor checklist, right? When you're going through things, knowing so you don't make mistakes, right? How are you going to find the markets to invest in? We show you the step-by-step, how you get to the emerging markets, the things you're looking for, metrics, statistics, the websites. We give you all of this stuff, all of our vendors, all of our suppliers, everybody that we use, you get access to. You want to know all the websites to go that are free to research and get all this information? We give you access to those. All of this stuff is included. Okay, so now let's talk about how you would analyze a deal. Now, we get into grave detail. We give you pro forma templates. We analyze them in real time. We go through deals. I'm going to actually go through one briefly. I'm going to pull it up here in just a minute. But I wanted to show you the structure, because once again, I try and keep it simple. Whether you're buying a 2-unit deal or whether you're buying a 100+ unit deal, it's the same financial process. You're going to take the gross rents on the property. Let's call that $10,000 a month. You're going to remove what they call an economic loss. This is vacancy, physical vacancy in the property, bad debt, meaning people not paying rent, loss to lease, which is, hey, market rents are here, but you're only getting here, loss to lease, and then concessions, things that maybe you're giving people a free month's rent or a couple $100 here to move in. So all of that combined is considered economic loss. That gets you this number called operating income, also known as effective gross income, EGI, right? Now you're going to take out all your operating expenses. This could be property taxes, insurance, maintenance, utilities, right? All that stuff that's going to come off of your effective gross income, your operating income. That's going to get you this beautiful number that everybody talks about called net operating income, NOI. Net operating income, NOI. Because this number is really important, because this is how you value a building. Unlike, say, a residential property where you are looking at comparable properties in the neighborhood to say, hey, my home is like this one, it's like this one, I adjust for here, and therefore my property is worth X based on all the comparable homes in my neighborhood. It's not how any commercial real estate is done. It's based off this number divided by what they call a cap rate. Once again, we get into this detail in the mentorship. I don't want to dive too much into the weeds. I just want to give you concepts here. So by that number, you can get a valuation on the property, okay? Then you're going to take out your mortgage, your loan on the property, and then that gets you the free cash flow. This is the bling bling that goes to you in your pocket, called mailbox money, or to you and your investors, right? All the free cash flow that comes out of the property. But this is the structure. And it doesn't matter whether you're getting a 2-unit property or you're buying a 100-unit property, you're going to see the exact same flow structure. There's just more zeros involved when you go from here to here. That's it in simplicity, okay? Okay, so real quick, I'm going to show you 2 deals that are our deals, how we would structure them typically, right, between your money and investors' money and how that's going to look, and then really show you what kind of money you can make if you're doing this and putting these things together. Either you're doing it fully on your own, right? Or you're joint venturing with other investors and partners. Maybe they call syndicating, where you're raising money from other investors and you're the main sponsor of it. Either way, I'm going to show you how that breaks down real quick on 2 deals that we currently have. Okay, let's go. All right, so let me show you how that property, the courtyards, how we broke that one down and how it's structured from ourselves and our investors in profit splits. So this is going to be you, right? So this is me on the deal, and this is going to be your investors, okay? Or our current investors on the deal, okay? They're getting 70% of the deal. I'm getting 30% of the deal, okay? Brought in 10% of the money. Brought in 90% of the money. See how that works? That's just from the structure standpoint. 30 and 70, so 30% of all the free cash flow, 30% of the profits, 30% of all that stuff I get for bringing in 10% of the money. And we're going to show the breakdown here in a minute, okay? But that's how that gets structured. Now, the greatest part about this, because I'm the general partner, that's what it's called, and they're the limited passive partner, right? I get to double dip because I get to play ball here, and I'm getting this 30% when I produce numbers. As the limited partner over here, my money, this 10%, is actually invested right alongside their money. So that way I'm getting the 70%, all the benefits of the LP, the limited partner investor, plus I get the 30%. So I get to do this double dipping game. That's the best part about it, because you're invested right alongside your investors and you're getting this promote when you produce. So you don't get this unless you produce here. So that's why your money goes over here, so you're getting a benefit, and then when you produce the numbers, you get the promote, the big profit. That's how that works. Let's show you the numbers right now. Okay, so breaking this deal down, this one we bought for $1,585,000. That was the purchase price. About $300,000 in renovations, $115,000 in closing costs, all in, give or take, around $2 million for this 31-unit deal. $1.4 million is your loan, okay? $600,000 equity. Now, how does this equity break down? This is between you and the investors. You're going to bring in 10%, so you're responsible for this 10%, 60 grand. That's it. For that, you're going to get 30% of the deal. And you get to double dip because you're going to play ball alongside the investors. So most of the investors, they're bringing in the 540. Now, think about this. I want you to think about this for a minute, because this is an actual deal. This is me in the deal. I'm the general partner. I'm this guy right here. $60,000 I brought into the deal. Now, let me show you what I've made on the deal. You get fees. You get an acquisition fee for putting the deal together. That was $47,000. Currently about $1,000 a month in an asset management fee for managing the deal, making sure it's running correctly for all the investors, everybody involved, okay? Also, I'm getting 30%, okay, of the deal, of the cash flows. That's currently around $2,100 a month. Plus, we refinanced the property recently, and by doing that, we pulled all of our money out. So this $60,000 I got back by doing the refinance. So now we're playing with house money, because now we've increased the loan amount because the value went up so much. We cashed out, refinanced, okay? I got all my money back. The best part about that money back is it's tax-free. It's tax-free. That's the beauty of cash out refinances under the tax code. So now I got my money back. Now I'm getting all this money up top. It's all flowing. And when we go to sell this thing, I'm projected to make another about $390,000 projections on the sale of the property. So I want you to think about this for a minute. $60,000. $47,000 I got the minute we closed the property. $60,000 I got $47,000 back from day one. So I technically only had $13,000 in actual cash in the deal. Then I'm getting an asset management fee every month. Then I start to get all the cash flows once we're renovated every month. Then we do the refinance. I get all my money back, tax-free. Now we're also getting cash flow, because now the property's pumping out cash flow every month, and it's not even calculated in this right now. This is just the fee-based stuff, and the profit from the sale. So you get all the cash flows that are coming out, right? 30% of the cash flows, and then $390,000 from the sale. So I mean, you can calculate that. Now we've owned the deal now for 4 years, right? So you can calculate this for 4 years, calculate this for 4 years, right? And then this is going to come out at the sale. So I hope you're computing this. $60,000 in, I got that back almost immediately through the acquisition fee. I had $13,000 in. When we did the refinance after 2 years, I got all my money back out. Plus I'm getting cash flows on top of that. I mean, my return is like 14 million%. Do you see how this works? Now, not every deal is this great, but this is one example. I'm going to show you another one right now too. Okay, this is another deal. This is a larger one, right? The one I just showed you is 31 units. This is a 121 unit deal. So remember what I said, whether it's a 2, 10, or 5 unit, all it is, more zeros. So all it is, more zeros. So I'm going to show you how this breaks down. So this one, we bought for $12.9 million, $2.1 million in renovations, $700,000 in closing costs, right? We had about $15,700,000 in total in the property. We're going to break this down, about $10.7 million in a loan amount, the difference in equity, about $5 million in equity. Okay, so now the question becomes, how does the equity get split up? Well, we brought in 10%. Okay, I brought in 10% in the deal, $4.5 million from investors, 10% and 90%. We have 30% of the deal. Investors have 70% of the deal. The benefit of it is now I get to play in both sides of it. Okay, so let's break down the fee structure. The minute we close the deal, I want you to think about this for a minute. $500,000 in. The minute we closed it, I got $387,000 out. Acquisition fee. So now, do I have $500,000 in? No, I don't. I have a lot less than that. I have 100 and something thousand of actual cash in the deal. Now we're also getting $25,000 a year in an asset management fee. It's going to be for over a 5-year window. Plus I'm going to get $80,000 a year, okay, in an estimated free cash flow coming out, times 5. Then I'm also going to get $40,000 a year at an 8% preferred return, because that's an 8% on my money. Remember, I get to play on both sides of the deal. Once again, we get into all this in the mentorship, but I'm trying to show you how lucrative this can be when you do it correctly. Okay? Now keep in mind, you're making this money because you're doing so well for the investors. If you're not doing well for the property and investors, this doesn't happen. So obviously it's a risk reward, it's a benefit, and you're aligned, because if you produce, you get paid handsomely. That's how it's designed. So you get the $40,000 a year on your money, my $500K that's in the deal, plus I get the percentage of the 70%. Remember, I get the 30% that we talked about, plus I'm get to play in the 70%. Now we're estimated to make about somewhere between $3 to $5 million on this deal. As the general partner, I'm going to get 30% of that. It's another $900,000 on top of all this cash flow that's coming out. I mean, are you doing the math on this? It works. So this is why you do it, okay? This is why you do it, and we're going to show you how to do it too. I know that people want to say, hey, you can do things with no money down, no this, no that. You don't need any money. You don't need to do anything. Look, technically that's accurate, okay? Because, you know, you can have partners, you can have other people that can help bring in the OPM, right? The other people's money. But realistically, you're going to need something, right? So if you're looking at this and questioning, I mean, $15,000 to $50,000, if you have that disposable to you, you can get into this game and start making some great money and start doing some things in the multifamily space, okay? That's kind of what you realistically need to expect. Okay, now I'm going to walk through a quick little case study in layman's terms to show you how you can actually buy a 10-unit apartment building in the next 90 days, how you would obviously find it. This deal that's right behind me was found on Crexy.com. On-market deal, 10 units. This one is in Huntsville, Alabama. Great little market. Did you know that Huntsville, by the way, has the highest concentration of PhDs anywhere in the United States? The Rockets. I didn't know this. Great little pocket market. Highly affluent, great pocket of market in the United States. Huntsville, Alabama. So in this case, this is a $625,000 deal, right? They're selling it at $62,000 a door. And we're going to put about $100,000 in improvements to the property. We're going to put 40% down. Okay. And closing costs you're going to put in here. This is one of the pro formas we use that you get, and we walk you through how to do this. Okay. But just so you understand this. So your total equity in this deal, if you're putting 40% down, you're getting a loan for this, which is $375,000 loan. You're getting a $250,000 down payment. Then you add in your improvements. So you call it $400,000, a little less than $400,000 out the door. Okay, $400,000 equity in the deal. Now you may be saying to yourself, Justin, I don't have that money. I'm not asking you to have that. I'm going to show you exactly how you put something like this together. So let's say it was $387,000. This is your total equity in the deal. Now, if you have all that money, great for you. Then you can do the entire thing yourself. Most people don't. So how does a deal like this get structured? Okay, you need this amount of money and you can go buy that deal. So this is going to get split up typically like this. 10% is going to be your responsibility. So let's call that $38,000. 90% is going to come from friends and family. This is going to be about, call it, I don't know, let's just make it for simple round numbers, $350,000, okay? So $350,000 from friends and family. Now you may be saying, oh, Justin, I don't have friends and family. Yes, you do. Trust me. People know people that know people. If you have a deal that makes sense, and in this case, this deal is going to produce, this deal right now, based on these projections, is going to produce close to a 19% annual return. Okay? 19% on your money. So if I went to somebody and I said, listen, show them the numbers, back it up. We should give you the pitch decks. We pitch decks like a marketing piece that you would show to somebody saying, hey, if you give me 50 grand, this is what you get. This is the property. Here's all the details. We need the money for 2 to 3 years, and boom, 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 boom. Simple little pitch deck that goes out. That way you have a piece that's ready to go to show to anybody and everybody that has interest in the property. And then you can go raise the money. Because I can guarantee you, you're going to raise this money with probably 3, maybe 4 people. 3, maybe 4 people. We show you how to do that. Now, once again, if you can do this all on your own, this 350, awesome. This 387, excuse me, awesome. Do it. But if you can't, this is how you break it down to where you're only coming in with about 38 grand. More reasonable. You can raise this relatively easily if you're going out saying, hey, I can show you a 19% projected return on your money over the next 3 to 5 years. Okay? Typical time frame on a business plan. And, here's what you get. Boom, 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 boom. And you give us the money here, you're going to get some money here, you're going to get cash flows, right? And then you're going to get big chunks here at the end. You're going to get a big chunk here in the middle from a refinance event, and then you're going to get cash flows throughout the term of the deal over 3 to 5 years. And you're going to get a 19% projected annual return on your money. And this has nothing to do with even talking about the tax benefits yet. That's just straight between cash flow and profits. That gets you the 19%, okay? So you can do this. And that's how you would structure a 10-unit deal in Huntsville, Alabama. Beautiful little property. That's how you take down a deal like this, right? 10-unit deal. Totally manageable. Huntsville, Alabama, $625,000. Right now in today's market, you will need to put that down. Okay? So your total all in with improvements to improve the property and renovate the units, because you're going to want to boost the rents and do all kinds of other things. And we kind of show you this and we break it down in the pro formas, but don't let this overwhelm you. But this is one example of a case study. So look, we're back on the process of buying apartments. And over the next 60 to 90 days, when you come into the mentorship, I'm going to be teaching you all of this stuff. And in our weekly live coaching sessions, this is what we go through. And we're going through actual deals that students are bringing, that they're doing around the country. Right? To give you an example of one recently, we had Hayden and Matt. They're buying a deal in Kansas City, Missouri. A 28-unit deal, one of their first ones that they're getting into. They're super excited, got into escrow, due diligence, going through that entire process, right? They found the deal, they underwrote it, it made sense. We helped them do that, raising the capital, and then they were in the process of closing it. So, and that's where they're at right now, and they're most recent. And another student, Vanessa, she actually just bought an 18-unit deal in Texas, right? Where she brought in about $48,000 of her own money, raised about $700,000 of investor money, and put the deal together, right? 18-unit little deal in the Denton area north of Dallas in Texas. So that was another little good one recently. Another great student is John in Decatur, Georgia. He came into the program about 120 days ago, got a deal in Decatur, Georgia. Ended up putting about $50,000 of his own money, okay? Raising about $450,000. Right, from others. And his return is going to be close to 32% a year, right? Because he's the general partner on the deal. These are the other folks. They're going to be around a 19% a year on that deal. We show you how this all breaks down. But his cash flow, once this thing actually starts pumping out, he's going to be sitting around $3K a month. just on this one little deal. Now, here's the thing. What people don't understand, especially when you're running these things and you're buying them, you have fees that are involved. No different than if you were a real estate agent getting fees for commissions. You have acquisition fees, you have management fees for it, asset management fees. You have maybe sometimes you get a disposition fee for selling the property and so forth. So there's fees baked into this too along the process, along with your cash flow, right? Plus the tax benefits, and you get the profit side of it. So when you're looking at this thing and you're sitting there making 32% on your money or more in some of these cases, these deals are incredible, right? And you combo that with the cash flow, tax benefits, profits, right? Plus you get some of these fees built into it. Trust me, it's highly lucrative when you execute correctly. We show you how to do this. I would not be in this if we were not doing well. I'm not here to work for free. I'm here to help people grow my businesses, doing what we're doing, right? Getting to our 4 billion and 10,000 units, but helping a lot of people along the way, because I know in order to do that, execute that, and expedite that process that I'm trying to do on a bigger level, a community of investors and people all around the country where we're doing deals together. Maybe there's some deals you want to bring to the table. Awesome. We would love to consider partnering with you. But if you're taught and educated right and mentored right, then you know how to look for them. You know how to find them, analyze them, put them together, raise the capital, all that stuff, right? And we can help be a part of that process. That's why the Multifamily School has come together. Having a massive community of like-minded investors and individuals is why this is going down. So why it's, people are asking like, why do you teach? Why do you do the mentors? It's because of that. It's mutually beneficial, trust me. So just to give you an idea of some of these deals going down, and there's more behind this. Happy to chat more about each of the ones, all of our students. We have plenty of them that are doing things and being highly active around the country, getting into their first deals. Some of them start with like a 2-unit, 4-unit, especially now with Fannie Mae and FHA type stuff that's going on, allowing you to buy with as little as 5% down, and you can get into it and they'll underwrite the property financials, not yours. At some point, I'm gonna have to stop doing these one-on-ones because my time is limited as we're growing this 9-figure, 10-figure type business and assets. So now is your chance to get in and take advantage of this. I only want to work with action takers, and that are people that aren't just gonna sit on the fence waiting and thinking they can just do this on their own, right? Trust me, I thought so too. I got mentored and partnered, and that's how you get there. But you have to be willing to invest in yourself, and you gotta go. And you have to be an action taker and move the needle for yourself so you can get to where you need to go. The team's gonna give you a custom game plan, and look, if it aligns with you as well, then we're gonna get you signed up right there on the call, and let's get you going. Let's make this happen for you. Get into this thing, we're gonna handhold you and make this happen for you and take you from zero to hero in this process of multifamily. So thanks so much for your time. Take care. We'll talk to you soon.